Income Tax 2020. Tax software example, car and truck expenses. Come in, relax with Income Tax 2020. Here we are in our Intuit tax software. You don't need the Intuit tax software in order to follow along, but I do think they have a 30-day free trial, so if you can get access to a free trial, it might be a good tool to practice with. We're going to be focusing in on the Form 1040 and the related Schedule C, concentrating in on the auto deduction, auto expenses within it, looking into the mileage method as well as the direct method, jumping back and forth from the data input to our forms to run different scenarios, the software making it easier to do so. Starting point, we're going to have Eric Smith living in 90210 Beverly Hills. We have then the starting point for the Schedule C, having income on the bottom line of the Schedule C of the 100,000 flowing into the first page of the 1040. At this 100,000, we have the above the line deduction, which is related to half of the self-employment tax that's going to be included here up top. That's being pulled in from the Schedule 1, as we can see. That's coming from, ultimately the Schedule C and then the self-employment tax, Social Security, Medicare on it. Then we have the adjusted gross income, the standard deduction, which is not tied directly to the Schedule C, but rather to anybody, the single filer standard deduction. And then we have the qualified business income deduction, which is not really our focus here. And then that's going to give us our taxable income down below the 64,428. So we're focused here on the Schedule C. Let's go on over to the Schedule C. We've got our income up top and then our expenses down below. The only expense we have included is the accounting expense down here because that's obviously the most important one. And that gets us down to the 100,000. We want to be concentrating now on the car and truck expenses. So we have the two methods that we can use for the car and truck expenses. Often going to be a confusing component when you're doing the tax preparation, because you're always going to have to stop at the car and truck expense and basically figure out what it should be there. Now, note also that the more complex your Schedule C business is, you might want to create basically a worksheet to be calculating the Schedule C. And we may take a look at that in more detail in a future presentation on what a worksheet might look like. Or you might take basically the income statement and then put in any adjustments that may be variant from the income statement provided to you. For example, for things like the car and truck expense and possibly home use of an office, if that is applicable. So we could then try the jump to feature. We could jump to the vehicles up top. So I'm going to go on to the vehicles. Note, within Lacert, we got the sheet of 2106. That's going to be basically the form sheet that we're going to put this into. We can also enter this data into the depreciation screen here because that's what we would need to do if we were taking the actual expenses and possibly enter the mileage information there as well so that the software can take the greater of the two if applicable. So we'll see that shortly, but let's start here. We're going to be pointing this to the Schedule C. So we're going to fill this thing out and say, I want it to go to the Schedule C as opposed to rental income or some other location. Then we're going to say that the activity, I'm going to say support services. And now this would only be applicable if it was going to Schedule A here. And so we're not going to go to any of these items. Then we have the employee business expenses. Meals, we're looking for the vehicle. So we're going to go down to the vehicle information. Vehicle is used primarily by one or more than 5% owner. So I'm going to say yes. Vehicle is available for off-duty personal use. I'm going to say that it is available for off-duty personal use. No other vehicle is available for personal use. That may or may not apply. No evidence to support your documentation. No written evidence to support your documentation. So I'm going to keep it at that. We're going to then go down. We're going to put in our miles here. So we got the description of the vehicle. I'm going to be generic here and just say truck. It was placed in service. I'm going to say at the beginning of this year so we can test out whether or not we want to use the mileage method or another direct method. So I'm going to say this was 010120 placed in service, the number of miles. Now, when talking to a client, you're going to have to ask, obviously, or if you're doing this yourself, you're going to think, well, how many miles did I drive? The more accurate your records, the better you will be in the event of an audit, obviously, on it. So we're going to have to estimate. We might have to estimate it. We're going to say, all right, 20,000 miles total. That's going to be total mile, business and personal. Now, then the business miles, if you used it part for business and part for personal, these are the ones that you want evidence of. And you can have evidence possibly about tracking where you go and then having the directions to that place, and then, you know, mapping out the directions so you can get the miles on it, possibly by looking it up online and finding the directions and how long it takes. So when you log this stuff up, you can get your business miles. And you might have to estimate this. You can say, well, if 20,000 total, I'm going to estimate it here, 90%, I'm going to say our business. So I'm going to say 18,000 business. So one more time, 20,000 times 0.9. We're going to say 18,000 business. The commuting miles, remember, you can't really deduct the commuting miles, so they should not be included in the miles that you're going to be calculating the rate by, because, again, the IRS kind of thinks of the commuting miles as similar to if you're a W-2 employee, you don't get the commuting miles to work. And so the same thing they're thinking, that's my justification for the law then, is the same thing for the business here. Then the commute shouldn't be deductible, they're saying, basically. So let's say that we work 5 days a week times 52 weeks in a year, and the commute is, let's say the commute is 3 miles. So I'm going to put commute is going to be, total commuting miles is 780. So then we have the round trip is only applicable for 2016. We've got the number of months of business use if changed from 100%. So we're going to keep it at 100% for the whole year then. So obviously if you choose something other than 100%, meaning you started your business like in the middle of the year or something like that, then it would prorate for the fraction of the year you would think there, right? Parking and tolls. So parking and tolls for business only, we might be able to include even though using the mileage method. And then we could force the actual expense or force the standard mileage. And this is for California. We could delete this year, delete next year, and then we have the actual expenses. Let's leave it at this for now and just see what the software will then do for us. So we're going to pull this over. We can see then we got the $10,350 then in the car and truck expenses. The worksheet will then give us the documentation on that. So if I select the worksheet here, we got the documentation. So we got the 20,000 mileage. The business miles are the 18. So the business use, 90% business use. So if I have anything else like that's the ratio that we would be using, you would think, from business to personal here. And then we have the multiply line 3 by the 0.575. That's going to be the rate, 57.5 cents. So we're going to be taking the 18,000 times the 0.575, and that's going to be that 10,350. That's the deduction that we have. Depreciation portion of the mileage, 27 cents. And the operating expense portion of the mileage is going to be here. Actual expenses, we don't have any because we haven't entered that. Now, again, obviously, if you have the income statement from the client, they're not going to have 10,350. They're going to have whatever they actually spent for the miles there, and you're going to have to make an adjustment for it. So you have the documentation that, you have the mileage method, and you want this net income then to tie out to what the client has. And we might talk about that more in a future presentation, just to see how you can document that in like an Excel worksheet if you so choose. But you can also just make an adjustment at the bottom of the sheet. Now, if I go back on over and I had, let's say we had some parking and tolls, we can actually include that. So let's say we had another, 500 in parking and tolls here, and then I'm going to go back on over, and that would be included. So now we're at the 10,000. The parking and tolls have now been increased, so now we're at the 10,850. So even though we're not taking the direct for some reason, we can include the parking and tolls there as well. So now let's go back and say, okay, well, what if we did the direct method, and then what if we compared the two? So let's try that. I'm going to go back on over, and let's see if I'll try to memorize this, but I won't save it. With 20,018. So I'm going to delete this for now, and let's put it into another screen. So the truck, I'm going to remove this whole thing. Going to totally remove it. I can just delete it right here. That's what I should have done first. So now I'm going to go to depreciation and depreciate then. And so we're going to put here generic name. I'm just going to call it a truck. So we're going to say truck, the form that it's going to go to. Instead of going to the Schedule C, I'm going to go to the Form 2106 so we can do a comparison if we so choose between the mileage method and the direct method. The activity we're going to have is going to be activity 1. And then we're going to say the category is going to be the automobile category. I'm going to say the date in service is going to be the beginning of this year, or the taxable year 010120. Cost, I'm going to say, is the $30,000 cost of the truck. Then I'm going to go to the method. The method that we're going to be using is going to be a maker's method. I'm going to use the makers with the auto limits. If you have a large truck that's over the 6,000 pounds, you might choose the one without the auto limits. The auto limits will typically or possibly put a cap on the amount that you can accelerately deduct, the amount that you can deduct in the first year. That acceleration, which is basically the double declining balance, front loading the amount of the deduction you get, is why the IRS is skeptical or won't let you oftentimes jump from taking the direct method at the first year and then switching to a mileage method in following years, because that means you're going to take a huge depreciation deduction in year one, and then you switch to the mileage method in year two. That's kind of cheating. So we're going to take the maker's method. We're going to go maker's method here, and then now down below, we're also going to say that we used it 90% for business, just like we did in our mileage method practice problem. So how do we do that? I'm going to go down to the data input screen, and we can only take the depreciation related to the amount that's used for business. We have this percentage here. You can estimate the percent, which we said was the 90%, or we can use some kind of mileage ratio. For example, if 18,000 miles were for business divided by 20,000 total miles, that'll give you our 90%. And you can try to ask that of the client. Well, how much do you think were business miles? How much do you think were total miles? And then you can use the ratio to give you that 90% here to test out the mileage method. So I'm going to say 0.9, 90%. For the miles. Now, if we take that and pull that over to the forms, notice nothing is populating in here yet. What I'm going to do is go back on over and compare and contrast it to the auto miles. And let's say I put the miles down here, and I'm going to go down. This is where we would enter the automobiles and other listed property. So no evidence, no written evidence supporting utility over the 6,000. I'm not going to check that. We have the use of vehicles. Vehicle is available for off-duty. I'm going to say yes. No other vehicle is available for off-duty. So if that would be applicable, you can have that. Vehicle is used primarily by a more than 5% owner. I'm going to say yes. Number of months of business use. I'm going to say it was for the full year. Employee providing vehicles. That's not applicable here. The auto miles. Now let's go back to our auto miles, which we said, I believe, was what did we say? 20,000. And then we said 18,000 here. Let's put it down to 10,000 here. And then if we go back on over to the forms, you can see now it's populating under depreciation because it's basically taking the depreciation as opposed to the auto at this point. Or in other words, depreciation direct method as opposed to the percentage method or the mileage method. Now, if I go to the vehicles worksheet up top, then we got our worksheet again, the date placed in service, total miles, we got the business miles, and then the business miles use percentage. We got the 50% usage percentage now on the business miles. Down below, we have multiplying out, that comes out to the 5,750, and this is breaking out between the depreciable portion and other portions. So that would be the mileage method. And then if I go down here, we have the depreciation, which is coming out to the 16,290, which is of course greater than that 3,000, and therefore it's picking to take the actual expenses as opposed to the mileage method. Again, you want to be careful doing that because that kind of could lock you in to taking that method going forward, and it looks better in the first year possibly than following years due to the fact that you're taking an advanced or accelerated method of depreciation. So now we may have then other things on the direct method. So you can also enter, the other items other than depreciation here. That would be under the automobile items. So then I'm going to go down and say, okay, that we got the depreciation there. Now let's add the actual costs. And let's say we had, gas and whatnot. I'm going to say, let's say 6,000. We would have to track this information, of course. Repairs, let's say 3,000. Tires, let's say, 450. Insurance, miscellaneous, auto license, and so forth. And so these would be the actual costs that you'd be counting up that would be on the actual side of things. If I go then back on over to the form, now notice we have the depreciation recorded down here in the depreciation item. Then when you have the car and truck up top at the 4,725, again, if we look at the worksheet here to check it out, we have then the standard rate method, and then down here we've got our actual method where we have the gasoline, repairs, tires, and so on and so forth. Now, if we go down to the depreciation schedules down here, we could say depreciation schedule 2020 for the regular depreciation, we got the car 30,000, 90% business use, the 16,290 of the 179. That's an accelerated method. So we've got a 179 deduction we're taking there. If you look at the regular, this gives us a little bit more detail. 30,000, 90%. So 16,290. Then that gives us the depreciation basis, subtracting those two out at the 10,710. So the fact that we're taking this 179 kind of can be a little bit more complicated than just standard depreciation, but basically we're getting more depreciation in the first year is how the 179 is in essence working. Now let's look at a situation where possibly using the mileage method would be greater. And again, you want to be thinking about the full year, not just the first year, but whether or not you're going to use the mileage method in future years as well. So let's go back on over and say, okay, well, what if like I did the same thing, but I'm not going to, the actual expenses, I won't put anything in the actual expenses for the car and truck here. So I'll remove these, remove that. And then we're going to say that this was our 30,000 and then the 18,000. Actually, let's take this, let's make this actually, let's say this was 45,000 and then let's take 90% of that. We're going to say, okay, 45,000 total miles times 0.9. So let's say this is going to be the 40,500, 45. And so there we have that. And then up top, let's say the cost down up top here was 20,000 and see what that looks like. So I'm going to say, all right, so if I go back on over, so now we're up at the car and auto, meaning it's not depreciating anything. So it picked the greater of the two, which in this case was the mileage method now. So if I take a look at the worksheet, so now we've got the 45 and the 40,005, which is 90, and we compare that. Then that gives us, if we multiply that times the 57.5 cents, the 0.575, we got the 23,288. So we're taking the business miles here, of course, being the 40,500 times the rate, which was the 0.575. That's going to give us our 23,288, and comparing that to the depreciation here, it looks like we're at the 16,290 for the depreciation. So it picked then to use the standard mileage method. Now, note that even if the depreciation was higher, you want to kind of think about what happens in the following year, though, because notice that if you take an accelerated depreciation in year one, then year two could be substantially lower due to the fact that the depreciation will go down. You took an accelerated amount in the first year. If you're using a mileage method, then you would think that the following year you'd have a similar number if you drove a similar amount of business miles for the most part. So that's going to be the pros and cons of the mileage method. Oftentimes over the long run, then the mileage method might work out better or worse, and then in the short run, in the first year, the depreciation might kick up the depreciation in the first year due to accelerated depreciation methods.